Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Fundamentals of Budgeting and Forecasting. Budgeting and forecasting are essential components of strategic financial planning, enabling businesses to align their financial resources with their overarching goals. The fundamental principles of budgeting and forecasting form the backbone of effective financial management, informing decision-making processes, mitigating risks, and driving long-term success. Understanding these fundamentals empowers organizations to allocate resources efficiently, anticipate financial challenges, and seize opportunities for growth. Budgeting is the process of creating a detailed financial plan that outlines an organization's expected revenues and expenditures over a specific period. It serves as a financial blueprint, guiding management in resource allocation, performance evaluation, and strategic planning. A well-constructed budget provides a framework for managing financial performance, ensuring that resources are available to support operational needs and strategic initiatives. The first step in the budgeting process is to establish clear financial objectives that align with the organization's strategic goals. These objectives may include revenue targets, cost control measures, profitability goals, and investment priorities. By setting specific, measurable, achievable, relevant, and time-bound objectives, organizations can create a focused and realistic budget that supports their strategic vision. Once financial objectives are established, the next step is to gather and analyze relevant financial data. This includes historical financial information, market trends, economic indicators, and industry benchmarks. Analyzing past performance helps identify patterns and trends that can inform future projections, while market and economic data provide context for external factors that may impact the budget. For example, a company operating in a volatile industry may need to account for potential fluctuations in demand and pricing when developing its budget. With a comprehensive understanding of financial objectives and data, organizations can begin the process of revenue forecasting. Revenue forecasting involves estimating future sales based on historical data, market conditions, and strategic initiatives. Accurate revenue forecasts are critical for effective budgeting as they provide the foundation for projecting expenses and determining resource allocation. Various forecasting methods can be employed, including trend analysis, regression analysis, and qualitative techniques such as expert judgment and market research. The choice of method depends on the availability and reliability of data, as well as the specific needs of the organization. After revenue forecasts are developed, organizations must estimate their expenses. This involves identifying all costs associated with operating the business, including fixed costs, variable costs, and discretionary costs. Expense estimation requires a detailed understanding of cost drivers and cost behavior, as well as careful consideration of potential changes in the business environment. For instance, a company anticipating an increase in production volume may need to account for higher raw material costs and additional labor expenses in its budget. The budgeting process also involves the creation of a cash flow budget, which projects the inflows and outflows of cash over the budget period. Cash flow budgeting is crucial for ensuring that the organization maintains adequate liquidity to meet its obligations and support its operations. This involves forecasting cash receipts from sales and other sources, as well as cash disbursements for expenses, debt repayments, and capital expenditures. Effective cash flow management helps organizations avoid liquidity crises and optimize their working capital. Once the budget is developed, it must be reviewed and approved by senior management and the board of directors. This review process ensures that the budget aligns with the organization's strategic goals and financial objectives, and that it provides a realistic and achievable plan for the upcoming period. During the review, management may make adjustments to the budget based on feedback and changing circumstances, ensuring that it remains relevant and responsive to the organization's needs. Forecasting, on the other hand, is the process of predicting future financial performance based on historical data, current trends, and anticipated changes in the business environment. Unlike budgeting, which is typically done on an annual basis, forecasting is a continuous process that involves regularly updating projections to reflect new information and changing conditions. This dynamic approach allows organizations to respond proactively to emerging opportunities and challenges, ensuring that they remain on track to achieve their strategic goals. One of the key benefits of forecasting is its ability to provide early warning signals of potential financial issues. By regularly comparing actual performance to forecasted results, organizations can identify variances and investigate their causes. This enables management to take corrective actions, such as adjusting spending, revising sales strategies, or reallocating resources to address any emerging problems. For example, if a company notices a decline in sales compared to its forecast, it can take steps to boost marketing efforts or explore new revenue streams to offset the shortfall. Effective forecasting also supports strategic decision-making by providing insights into future trends and potential scenarios. Scenario analysis, a common forecasting technique, involves creating multiple projections based on different assumptions about key variables, such as market conditions, competitive dynamics, and regulatory changes. This allows organizations to evaluate the potential impact of various scenarios on their financial performance and develop contingency plans to mitigate risks. For instance, a company operating in a highly regulated industry may use scenario analysis to assess the potential impact of new regulations on its profitability and develop strategies to comply with regulatory requirements while maintaining its competitive position. The integration of budgeting and forecasting is essential for effective financial planning and management. By aligning the budget with updated forecasts, organizations can ensure that their financial plans remain relevant and responsive to changing conditions. This integration also facilitates more accurate and timely performance monitoring, enabling management to make informed decisions and take proactive measures to achieve their strategic goals. In practice, many organizations use rolling forecasts to integrate budgeting and forecasting. Rolling forecasts involve continuously updating financial projections on a regular basis, such as monthly or quarterly, to reflect the latest information and trends. This approach provides a more dynamic and flexible framework for financial planning, allowing organizations to adapt to changing conditions and maintain alignment with their strategic objectives. For example, a company experiencing rapid growth may use rolling forecasts to regularly update its revenue and expense projections, ensuring that its financial plans remain aligned with its evolving business needs. The use of advanced technologies such as data analytics and artificial intelligence has further enhanced the accuracy and effectiveness of budgeting and forecasting. These technologies enable organizations to analyze vast amounts of data, identify patterns and trends, and generate more accurate and reliable projections. For instance, machine learning algorithms can be used to analyze historical sales data and predict future demand with greater precision, while data visualization tools can help management identify key insights and trends in financial performance. By leveraging these technologies, organizations can improve the accuracy of their budgets and forecasts, reduce uncertainty, and make more informed strategic decisions. In conclusion, the fundamentals of budgeting and forecasting are critical components of strategic financial planning. By creating detailed financial plans based on accurate revenue and expense projections, organizations can allocate resources efficiently, manage financial performance, and achieve their strategic goals. The integration of budgeting and forecasting, supported by advanced technologies and continuous updates, provides a dynamic and responsive framework for financial planning, enabling organizations to navigate an ever-changing business environment and drive long-term success. As businesses continue to evolve and face new challenges, the principles of budgeting and forecasting will remain essential tools for effective financial management and strategic decision-making. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.